3 routine business activities that invite huge penalties. Did you know that some seemingly mundane, everyday activities in your UAE business could actually be massive red flags for anti-money laundering authorities, even if they appear normal on the surface? The UAE's financial crime landscape is evolving rapidly, and regulators are now looking beyond obvious illicit transactions to pinpoint subtle systemic vulnerabilities. This means what you don't know about your routine operations can cost you millions. Here are 3 deeply researched, non-obvious routine activities that often get businesses into trouble with UAE AML laws, even when there's no deliberate, malicious intent. First, accepting partial or staggered payments from multiple seemingly unrelated sources for a single high-value invoice. Many businesses, particularly in sectors like luxury goods, real estate, or even specialized consulting, might receive payments broken into smaller amounts from various bank accounts, often with different account holders, to settle a single substantial bill. This is a classic layering technique in money laundering, making it incredibly difficult to trace the ultimate source of funds, even if the transaction itself seems legitimate. Failing to conduct enhanced due diligence on all contributing payment origins and their economic rationale, not just the primary client, is a critical oversight. It demonstrates a lack of understanding of the true beneficial ownership of the funds. Second, onboarding clients based solely on initial digital identification, without subsequent verification of physical presence or consistent engagement. In the rush of digital transformation, businesses might rely heavily on initial online KYC processes. However, a less obvious risk emerges when there's no ongoing effort to verify the client's actual operational presence, consistent communication patterns, or alignment between their declared business activities and their digital footprint. For instance, a registered company with a virtual office might appear legitimate initially, but if there's no tangible activity, consistent engagement with local service providers, or verifiable physical meetings over time, it could indicate a shell company being used to obscure illicit activities. The routine lack of liveness checks beyond initial digital onboarding can be a significant vulnerability. Third, the informal recycling of cash or minor assets within a business ecosystem, without formal documentation or a clear audit trail. This is prevalent in cash-intensive sectors like retail, hospitality, or small trade, even if the individual amounts are below reporting thresholds. For example, using petty cash from daily sales to cover minor operational expenses without proper receipts or internal accounting entries, or borrowing small amounts from business cash registers for personal use and replacing it later. While seemingly insignificant, these routine, undocumented cash movements can obscure the true volume and source of funds entering and exiting the business. When aggregated, they create a black hole in financial records, making it impossible to demonstrate a clear audit trail if an AML investigation ever scrutinizes the business's overall cash flow, especially if coupled with a sudden influx of larger, unexplained cash deposits. These are not merely theoretical concerns. They represent critical systemic weaknesses that UAE regulators are actively flagging, often resulting in hefty fines and severe reputational damage. Ignoring these seemingly innocuous routine activities is a direct path to non-compliance. Share it with someone who needs it.